Hello, my name is Brent Foster, founder and CEO of Northbound Wealth Management. Welcome to the Northbound Wealth 2023 Halftime Report presentation. We're delighted to see you all here today and look forward to sharing some vital information with you. I want to draw your attention to these disclosures. Please take a few moments to review and let me know if you have any questions. Here to help you better understand what happened in the markets in the first half of 2023 and what may unfold in the months ahead. If you have any questions during the presentation, please ask by sending us an email at info@northboundwealth.com or by calling us at 317-399-1107. Chances are someone else is wondering the same thing, so if anything comes up, ask away and I'll be sure to include certain responses either directly to you or in the Northbound Wealth Management blog releases on the website or in the Northbound Wealth podcast, which is released every week. I want to thank Indie Pod Labs, Matt Zappizzotti, and Tom Markwell for letting Northbound Wealth use their podcasting studio for this presentation. I also want to thank all of my clients, and you know who you are, for continued and ongoing trust and support in launching Northbound Wealth Management. It is for you that we do this, and it's for you that we get up every morning and work hard every day to navigate these markets and provide sound advice and education. Thank you from myself and the rest of the Northbound Wealth Management team. Without further ado, let's dive in. Today, I'm going to focus on 4 key areas. We're going to, number 1, review the first half. Number 2, take a look at potential market forces in the second half outlook. Number 3, ask the question, where are we now? And number 4, and finally, take a look at what's ahead for the second half of 2023. Let's begin by reviewing how the stock market performed during the first half of 2023. Here is a snapshot of the S&P 500 index performance from January 1st, 2023 to June 12th, 2023. The S&P 500 managed to post a gain, helped by evidence of slowing inflation and the prospect of an end to the Fed's rate hike cycle. The communication services, consumer discretionary, and technology sectors were among the top performers in the first 5 months. The first half was dominated by 3 overriding themes: inflation, rate hikes, and recession fears. As inflation continued to moderate and the Fed signaled rate hikes may be nearing an end, fears of a potential recession became the dominant investor concern. In addition to these macroeconomic worries, the markets grappled with regional banking stresses in March that periodically resurfaced in the months that followed, as well as having to cope with the uncertainty generated by federal debt ceiling negotiations. We use a chart of the S&P 500 Composite Index because it's generally considered representative of the U.S. stock market. Index performance is not indicative of the past performance of a particular investment. Past performance does not guarantee future results, and individuals cannot invest directly in an index, and the return and principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. So we've talked a bit about how the S&P 500 performed so far this year, but how does that performance compare to expectations? At the end of each year, various media outlets compile some Wall Street analyst predictions for the year ahead. This image shows several projections shared at the end of 2022. How do those predictions compare to reality so far? The S&P 500 closed May 31st, 2023 at 4,180. The S&P 500 closed at 3,840 on December 31st, 2022. So year-to-date stock market gains have been quite solid. This is far better than what most experts had predicted, with 2023 full-year forecasts for 2023 very muted, coming off of a down 2022. Even the most optimistic forecasts in the table represents less than 5% increase for the year. The outlook was reflective of expectations that the economy would potentially fall into a recession, while interest rates would likely go higher. Predicting where the S&P 500 will be by the end of the year is always challenging, especially in 2023, this year, given the uncertainties of inflation, global economic growth, and rising interest rates. In the following slides, we'll discuss the factors that may impact stocks in the second half of the year. To create some context about where the economy may go in the second half of the year, let's start by examining where we stood in January 2022. We picked up this month as a reference point because it represents a moment in which the pandemic was now mostly in the rearview mirror. As the indicators suggest, the outlook for the coming 3 to 6 months was exceptionally optimistic. The Federal Reserve's monetary policy remains accommodative, and the interest rates had not yet begun their climb from their historical lows. On virtually every important economic indicator, from inflation and monetary policy to credit, demand availability, to energy costs, it was a flash positive. Only 3 indicators were neutral or cautionary: the political environment, equity market valuation, and geopolitical risk. There were no negative indicators. However, these conditions would soon reverse. Now let's jump to January 2023. In a short span of just 12 months, the economic outlook is done an about-face. We went from a set of speedometers that were nearly all positive to an outlook that contains no positive economic or financial indicators. After almost a full year of sharp and successive interest rate hikes by the Fed, there are now 7 indicators flashing red, most notably monetary policy, interest rates, housing, and leading economic indicators. The rest of the indicators are neutral. This is a good illustration, I think, of the impact across the economy and in the financial markets of going from near zero interest rates to about 5% in roughly a year's time. And things do not look any better 6 months later. In fact, you could say that today the outlook has deteriorated slightly. We sit with 7 red or negative indicators, the same number as January. Perhaps the most notable change is that credit demand and availability, that speedometer, has moved into the red. This is a direct consequence of the regional banking troubles we saw flare up in mid-March with the collapse of 2 mid-sized banks. This banking stress has led many institutions to be a more conservative approach to lending money, reducing loans to shore up the strength of their balance sheets. This may have significant economic implications since consumer and business borrowing are a major driver of economic activity. Fewer loans, in other words, may mean slower economic growth. And to that point, let's examine what leading economic indicators are telling us. This chart shows that the relationship between the changes in the S&P 500 performance and the 12-month forward earnings per share, or EPS. As you can see, the 2 lines have generally moved in the same direction over the past decade. However, as we can see, stock prices progressed ahead of earnings growth, which was then followed by a retreat in prices in 2022. Earnings have trended sideways for some time, however. More recently, stock prices have been trading in a limited range, possibly due to the lack of clarity surrounding corporate earnings. Here are a couple of reminders. First, past performance does not guarantee future results. The next 10 years, the correlation between the stock prices and the corporate profits may look different. Second, individuals cannot invest directly in an index. And third, the return in principal value of stock prices will fluctuate as market conditions change. Shares, when sold, may be worth more or less than their original cost. At the highest level, the Federal Reserve has 3 functions: to provide an effective payment system for the U.S., to regulate banking operations, and to set monetary policy. When determining monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. As it works to uphold its monetary policy goal, one of the indicators monitored by the Fed is the overall level of consumer prices, which helps it determine whether to adjust interest rates. The Fed has stated that it's comfortable with an inflation in the 2% range. The charts we're looking at depict consumer price inflation on a year-over-year basis and a month-over-month basis. As you can see, the year-over-year inflation those are trending lower, though inflation remains above the Fed's target inflation rate, which is one reason why the Fed continued to raise interest rates during the first half of the year. When we look at the month-over-month chart, the numbers can be a bit more erratic. Expect the Fed's decision on monetary policy to continue to influence the financial markets through the second half of the year. Amid the challenging headwinds in the first half of the year, such as interest rate hikes, regional banking stresses, and a slowing economy, the labor market has been highly resilient. Despite all the new layoffs, a potential looming recession, and higher business costs, the U.S. labor market remains healthy. The labor vitality was an important support to the market since having a job is foundational to consumer spending, which drives economic growth in the United States. This strength may be best illustrated by two labor market measures, the unemployment rate and current job openings. The unemployment rate continues to remain at historically low level thanks to robust hiring by private sector employers. Even in the face of this robust hiring, the percentage of companies unable to fill open positions remains quite elevated. By these two historical measures, the labor market appears healthy. The University of Michigan's Consumer Sentiment Index is one of the most widely used sources to help analysts understand how the average consumer feels about the economy. This index is valuable as it surveys at least 500 residents of the U.S. each month by phone. The survey uncovers consumers' opinions regarding their own finances as well as business conditions in the country. Understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of gross domestic product, or GDP. As the chart indicates, consumer confidence recovered from its historic lows in June of 2022. More recently, those gains have eroded as recession fears and concerns over the debt ceiling increased consumer pessimism over the near-term health of the economy. The financial markets were caught off guard by troubles at two regional banks in mid-March, leading to a sell-off that added to investor anxiety, and unresolved banking stresses may very well be an overhang in the months ahead. The banking sector issues created two concerns for investors. One was that this was the first sign of economic issues as a result of the Fed's aggressive monetary policy, which triggered fears about something else having troubles. Regional banks play a vital role in the U.S. economy. One investment bank found that a small and mid-sized banks account for roughly 50% of commercial and industrial lending, 60% of residential lending, and 45% of consumer lending. The second was the worry that the banking issues would reduce lending to businesses and consumers, leading to slower economic growth. But as you can see in the chart, the March concerns have eased a bit. A value above 1 indicates that financial stress is above the long-run average, while a negative value signifies that financial stress is below the long-run average. As you can see, financial stress spiked in March following the bank collapses and improved in April. The KCFSI is a monthly composite index of 11 variables reflecting stress in the U.S. financial system. These variables fall into two broad categories: average yield, spreads, and measures based on actual or expected behavior of asset prices. Now let's examine the present before we dive into what the future may hold. Let's take a moment to consider the variables that may weigh heaviest on market performance. We believe that the factors that led to the first half's market's performance may remain critical to how the market may behave in the second half. The first factor is inflation. While accelerating inflation is no longer a concern of the market, some investors, and perhaps more importantly the Federal Reserve, worry that inflation may prove to be sticky at these elevated levels. If inflation remains where it is presently, then it may be hamstringing the Fed if it has any intention of pausing interest rate increases in the second half of the year. Sticky inflation will also likely take any potential rate cuts off the table until inflation can resume its march lower, or the Fed raises its 2% target rate to, say, 3%, for example. Recession concerns have weighed on the market throughout the year. Even as the economy has remained resilient, however, cracks are appearing in the economy. Manufacturing is weak, the labor market is slowing, and leading economic indicators have been trending lower. Moreover, China, an important driver of global economic growth, has experienced a smaller than expected economic rebound. According to consensus Wall Street estimates, corporate profits may actually increase in the second half of the year, thanks in part to greater efficiencies, lower headcount, reduced capital spending, a weaker US dollar, and a still strong consumer. Expectations are modest, but healthy earnings surprises may lift investor sentiment and drive higher valuations. Of course, no one can predict what can happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. And finally, let's take a look at potential forecasts for the second half of the year. Economic growth may be an integral variable in how the markets perform in the coming quarters. To get a better insight into how economists think the economy will perform, we took a look at the May 2023 survey of professional forecasters conducted by the Federal Reserve of Philadelphia. We looked specifically at the consensus forecasts of three key economic factors that drive much of the market's perception about the state of the economy. They are GDP growth, unemployment, and inflation. As you can see in the charts, the consensus view as of May 2023, that is that gross domestic product growth is expected to be between 0% and 1.4% in 2024. Meanwhile, these professionals are projecting that the unemployment rate remains low at between 4% and 4.9% in 2024, and they expect inflation as measured by core personal consumption expenditures to be between 2.5% and 2.9%. Remember, forecasts are based on assumptions and subjects to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations expressed in the forecast. Some market strategists look at the bottom-up earnings per share to help set their price target for the S&P 500 index. When setting a bottom-up EPS, market strategists focus their attention on estimating earnings for all S&P 500 companies. By contrast, a top-down investing target price places a greater emphasis on macroeconomic factors when making an investment forecast. The chart shows the bottoms-up EPS and the price of the S&P 500. A word of caution is that this type of analysis shouldn't be seen as a perfect predictor of stock price performance, but in this chart, you'll notice how stock prices have been trending flat to higher, while corporate earnings are trending lower. When evaluating this chart, it's important to remember that the stock market is considered a discounting mechanism, which means that it always is looking forward. Put another way, the stock market's price today represents all available information about current and future events. How far forward is the stock market looking? Most would agree it's discounting activity 6 to 9 months into the future. So are stock prices seeing a turnaround in earnings? That's uncertain, and only time will tell. Here are a few things to keep in mind. First, past performance is not a guarantee of future results. Second, individuals cannot invest directly in an index. And third, the return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than the original cost. Considering the importance of corporate earnings to stock valuations, the comparison between them, the big question for investors is, what can we expect for future corporate earnings? In the previous image, it was clear that earnings have been trending lower during the first half of 2023. However, Market analysts expect that earnings growth will improve in 2024. If you take a look at the chart, you'll notice that earnings growth projections have been cut for nearly every industry sector in the S&P 500. Near the center of this chart is the earnings growth projection for all the companies comprising the S&P 500, which is estimated to be 11.6%. Some sectors are expected to do better, while others are projected to lag. Future progress on inflation may be a bit more difficult. One aspect of inflation in particular focus for the Fed, as well as market analysts and economists, is what we call sticky inflation. Sticky inflation refers to the components of the consumer price index that have historically exhibited a greater stickiness and rigidity with respect to price changes. So increasing of interest rates, right? In this chart, 12-month sticky inflation is the orange line, while 12-month CPI, which is the consumer price index core inflation, is the gray line. Sticky inflation includes many service-based categories, including medical services, education, and personal care services, as well as most of the housing categories. Fed Chair Jerome Powell has often referred to stickiness in services-related inflation as one of the reasons for remaining vigilant in the Fed's fight to lower inflation. As you can see in the chart, despite progress on overall inflation, the Atlanta Fed's measure of sticky inflation has been stubborn. Needless to say, the Fed has much to consider as it evaluates monetary policy. Among the biggest questions investors have heading into the second half of the year are, will the Fed pause on rate hikes, and will the Fed cut rates by the end of the year, especially if the economy slows down? The next 4 meetings of the Federal Reserve Open Market Committee, or FOMC, are likely to answer these questions and provide additional clarity for investors. The FOMC is scheduled to meet 4 more times in 2023. July 25th through 26th, that's later on this month, September 19th and 20th, October 31st and November 1st, December 12th through the 13th. Typically, if the Fed is going to make an adjustment to interest rates, it will announce the change following their 2-day meetings. And so far, I've been covering all of these Fed meetings and the responses of interest rates on the weekly Northbound Wealth Management podcast, which you can tune into on Apple, Spotify, anywhere you listen. Even on YouTube, I post the audio there. And I'll be doing a lot more of that heading into the end of the year and looking at 2024, so stay tuned for that. Here's another relationship to understand. Bond prices and bond yields have an inverse relationship. In other words, when bond yields go up, bond prices go down. After experiencing years of low interest rates, some investors may be surprised to realize their bonds can lose money if sold before they reach maturity. Bond values may decline during periods of rising interest rates, but a changing tide in the economy doesn't mean that you have to abandon fixed income. Often, this movement is an important part of a well-balanced, diversified portfolio that may provide investors with the income they need. However, keep in mind that there's no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification is an approach to help manage investment risk. It does not eliminate the risk of loss if a security price declines. Tuning out the headline noise while managing your finances is not always easy. However, wise investing involves more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on fundamentals like a company's earnings or economic data. We've gone over a lot today, but I'd like to conclude with a longer-term perspective on the financial markets. Having this perspective, I think, is key when pursuing the financial goals we've set out for ourselves. After a disappointing 2022, frustrations may be high surrounding the progress of your investments. That's why this analysis of bull and bear markets during the period from May 26, 1970 to October 12, 2022 is critical to review. Here, we see that the average bull market lasts nearly 76 months. On the other hand, the average bear market has run a little over 15 months. As of May 2023, we were in a bear market that started in June of 2022, when stock prices dropped 20% from a recent high. Into early June, however, some were saying we've entered a new bull market, so stay tuned. We can see above the rewards of growing an innovative economy often go to investors with discipline to remain invested over the long term. Remember, investing involves risk, and investment decisions should be based on your own goals, time horizon, and risk tolerance. The S&P 500 is an unmanaged index. It's generally considered representative of the U.S. stock market. Index performance is not indicative of past performance of a particular investment. Past performance does not guarantee future results, and individuals cannot invest directly in an index. The next point I'd like to convey is a cautionary one on the temptation of getting caught up in exciting new investment themes. This chart illustrates such exuberance happens from time to time. As you can see, faddish themes have occurred fairly frequently since the 1970s, when gold rallied higher only to trend lower. These trends can develop in broad markets like Japan and Asia in the late 80s and 90s, or they can form in certain asset sectors such as internet or Bitcoin companies. Recently, artificial intelligence, or AI, has been receiving quite a bit of attention. What I want to emphasize is the importance of following a long-term investment strategy and not getting sidetracked by fads. Does AI offer the potential of meaningful capital growth for investors in the years ahead? It may very well. Sure looks like it. But there are ways to incorporate AI into an investment strategy that takes into consideration your goals, time horizon, and risk tolerance. Keep in mind that some of the investing fads you've been looking at can be considered sectors of the stock market, and because of their narrow focus, a sector investing strategy tends to be more volatile than an investment strategy that is diversified across many sectors and companies. Sector investing is also subject to additional risks associated with its particular industry. Sector investing can be adversely affected by political, regulatory, market, or economic developments. But I will tell you some of the best performing sectors over the last 40 to 50 years. There's two of them that are top of mind. Number one is technology, and number two is health sciences, life sciences, biotech. So those are two top over the last 50 years. And so they can benefit and help enhance portfolios over a long period of time. We've gone through a lot of information here, and I'm sure many of you still have lingering questions. Remember, if you're wondering something, it's more likely that someone else in the audience is too. So let me know how I can help. I'd be happy to write a blog piece or talk about it on my weekly podcast, the Northbound Wealth Podcast, and answer some of those questions, or at least attempt to. Also, if you have questions about your specific investment strategy, maybe how your portfolio could use some enhancements or some advice from Northbound Wealth Management, feel free to reach out to us. You can email us at info@northboundwealth.com, info@northboundwealth.com, or give us a call at 317-399-1107. Again, 317-399-1107. Thanks so much for your time today. As you can tell, I'm passionate about helping you understand the markets. For more information and timely updates, please follow us on social media and contact us anytime. We hope that you enjoyed the details we shared today, and we look forward to helping you navigate your financial future if that seems like an option for you. So We look forward to getting this out to everybody, and have a great rest of the year. The next time I'll do a State of the Markets call will be in January of 2024. All right, be safe, take care. God bless America.